This podcast is brought to you by Anthony Selby, a financial advisor in conjunction with House to Grow. House to Grow is a not-for-profit organisation which empowers communities through education for life, holistic wellbeing and health. We hope this series is helpful and impactful.
Hi everybody and welcome to today's episode of House to Grow. We're very lucky to have with us today JC. How are you, JC, from Periapt Advisory?
Nice to be here, Anthony.
Thank you. JC, you're a financial advisor, an independent financial advisor?
Yes.
And can you tell me very quickly a little bit about your business and what you do?
Okay, Periapt Advisory is a not-for-profit company. We try and help as many Australians as we can get independent financial advice in an affordable way, helping them as much or as little as they would like. For some people, that just means setting them up with the tools they need to go and do things themselves. And then for other people, we help them a lot more. It depends on what it is that people are looking for.
Excellent. Thank you. And where are you based?
In Adelaide.
In Adelaide. Excellent. Do you help people outside of Adelaide too?
We do. So a lot of people for this particular type of interest, they prefer to sit down with someone face to face. So we do have a lot of people who are from Adelaide or who drive, or from rural South Australia who drive in to talk with us. But we do have a few interstate people as well. So that's always nice.
Yeah, fantastic. Today we're here to talk about superannuation and retirement.
Excellent.
Two very interesting topics.
I think so.
I think so too. We can nerd out together. Basically, we're speaking today with a financial expert, that's you, about understanding super, retirement plans and maximising benefits through different strategies, no matter what your super balance. Also, technical strategies such as advantages and disadvantages of salary sacrifice to super and public defined benefit super schemes in the context of your financial life and estate plans will also be covered in a little bit of detail. So, JC, let's start with superannuation. What is it and why is it so important? A lot of people don't really actually know what super is.
Okay. Superannuation is basically a way of saving for your retirement. Now, because the government would like you to contribute as much as possible towards supporting yourself in your old age, they therefore try and offer incentives to make it attractive for you to save for your own retirement and to be less reliant on the age pension. So the main attraction or incentive or motivation that they offer is that they will tax it concessionally or at a discount. So if you are working and earning and accumulating superannuation, so, usually under the age of 60 or 65, then whatever you're putting into super and what it's earning for you will be taxed at 15%. Whereas if you have money outside of super, say you have a deposit in the bank or you have a share portfolio or you have an investment property, whatever that investment earns for you, you'll pay tax on according to your marginal rate of income tax. So that will be anywhere from 21%, including Medicare levy, up to 47%. Assuming you're earning more than the tax-free threshold amount of $18,200. So for most Australians, you're going to be paying tax at least that rate of 21%. So superannuation being taxed at 15%, that's a discount or a concession, and the government offers that so that you put your money into super and therefore you will have it saved aside for when you stop working.
Okay. I often hear clients say to me, I don't want to put my money into super because it's too risky. And I have to explain to them that super isn't risky. Super is just a structure. Super in of itself isn't risky. Can you clarify what that means?
Yeah, so you're spot on. Super is a structure. It's a rules for how it will be taxed and how it can be accessed. So you can invest in, for instance, let's say you think the Commonwealth Bank is a good bank that you would like to own shares in. You can hold those shares in your own name and then whatever money they make for you, you'll pay tax at your marginal rate. So for most of us, that'll be at least 21%.
Hmm.
Or you could choose to own shares in the Commonwealth Bank through your super fund. And whatever money it makes for you in your super fund, you'll pay tax at the super rate, which is 15%. So whether or not you should buy shares in the Commonwealth Bank or whatever asset you're looking at comes down to whether or not you think that's a good investment, and whether or not you hold it in super or in your own name comes down to considering what tax rate do I want to pay and when might I need to access the money. So
Okay.
super would give you a low tax rate, but you couldn't access it for a
Mm,
long time. Owning it outside
mm,
in your own name, you could access it whenever you want, but you may pay a higher rate of tax.
mm. Just to think of that example in another context for any listeners, instead of Commonwealth Bank shares, you could also just hold a cash account,
Yes,
or a term deposit. So I just want to
yes,
make that really clear. Super isn't by itself riskier, as JC's pointed out. It's just a tax structure for holding assets for retirement. So the actual assets that you hold in your super fund are up to you.
hmm, that's exactly right.
And it's so important, really, if I'm summing it up as well from what you're saying, because it's got all those tax concessions that the government gives us to save for our retirement. It's really important that we understand how they work, so that we
Yes,
can provide for our own retirement whenever that comes, because that's what they want us to do.
they do, absolutely.
Excellent. Now let's discuss some of those benefits, because I think, well, first of all, a lot of people are going to be really interested in what can I do to maximize my retirement income. What strategies are available to me? Are you able to give me a few of those for let's say lower income earners all the way through to maybe someone on a higher tax bracket?
Yes. So if you're on a lower income tax bracket, then one of the things that you might like to consider is taking up the government's co-contribution scheme. And what that is
Hmm.
basically it's capped, but for each dollar that you put into super of your own after tax money, so this is separate from what your employer is required to pay on your behalf. But each dollar that you put in from your own money, the government will match up to 50 cents of that, and they'll pay as much as $500. So if you manage to put in $1,000, then
Yep.
provided your income is below the certain thresholds, then you could have as $500 gift from the government, no strings attached. So that's my favourite
And
one because it's a guaranteed return.
yeah, 50% return if you get the full one. And to be clear, that could also be the case if you've got a lot of money. You just might have a low income, so in your own name. So you might have a lot of money in super. It's not only for it's for low income earners, but it can also work for wealthy people.
Yes, that's right, Anthony. The only requirement to be able to participate in that scheme is that you do have to have at least 10% of your income from your own exertion. So if you
Okay.
only had investments, like you just had an investment property and that was it, and that was
Yep.
the only money coming in each year, then that wouldn't be
Hmm.
income from your own exertion. So that wouldn't qualify. But if you had an
Hmm.
investment property and you also did a little bit of cleaning or something once a week for someone, well, that would qualify then. As long as you had 10% of your income from your own effort, you would be able to participate in the co-contribution scheme.
Excellent. So that's one, the co-contribution. I think that's a really useful one to know. Can you, for the second one, can you, I don't want to preempt you, but can you jump into the first home savers scheme? Because I think that one's probably helpful for some young people too.
Okay, so the first home super saver scheme is basically an opportunity to put money into super and then take it out to buy your first home.
Hmm.
Now, the reason you might be thinking, well, what would be the point of putting it into super if I'm just going to take it out again a couple of months later or a couple of years later? The
Mm.
main reason that you would want to do it would be that you could put it into super and claim a tax deduction for it, and
Hmm.
then and that would save you income tax now, basically you'd save whatever the difference was between your income tax rate and your marginal income tax rate. So that's going to be at least 21%, and the super tax
Hmm.
rate, which is 15%. So you'd save a minimum of 6%, and then you
Yep.
could save as much as 32% if you were on that highest tax bracket. So
Mm,
that can appeal for a lot of people as a way of just having more of your money working for you. Um, you do need to be mindful that you can only take that money out to buy your first home. So,
mm,
if, for instance, you changed your mind, maybe you decided to spend that money backpacking around Europe or Asia or something, you can't take it out for those purposes. It can only be used for buying your first home, but there's no requirement for that first home purchase to be made anytime in the near future. It's only
mm.
you've got to do it within 12 months of taking the money out to buy your place.
Yeah, and it could stay in there forever, like for your retirement, or if you had an emergency and needed, for the same reasons you could access your super normally, you could access it as well. It's just home or those reasons. Um, and then the other thing is as well, if I'm understanding how that works, you can also put money in instead of claiming a tax deduction. You can also put money as a non-concessional. So, like we were talking about just a moment ago, the government co-contribution,
Mm-hmm.
and that comes from what we call an after-tax contribution. So you've got to put up to $1,000 in of money that you've already paid tax on. So like your
Mm-hmm.
savings, you've
Mm-hmm.
been paid already. Um, you can also do that for the first home saver scheme. Would there be any benefit in doing that, or is it only just for that benefit of claiming the deduction as it goes in for a first home saver scheme?
So certainly that's a main benefit for a lot of people is claiming the deduction. But as you've pointed out as well, if you are a low income earner, that could be a way of getting that government co-contribution. So it's worthwhile in that respect. The other way that
Mm,
it works for people is if you're wanting to save this money towards buying your house. If you just put it in a bank account, you're going to get whatever rate of interest the bank is offering you, which is barely going to keep up with inflation. Now,
mm,
if you choose to instead invest it in maybe some shares or something, then there's the risk that at the time that you want to sell those shares and use that money to buy your house, that there's a possibility that that share portfolio will have dropped in value and you'll have less money than you started with. So
correct.
that's not necessarily the path that most people want to take either. If you put it into super, the rate of return of
Mm,
what you get is it's set down by the government as 3% above the cash rate. So you may
yep.
earn more than that, you may earn less, but you're guaranteed of getting that much as a calculated earnings on it, and that's going to be higher than whatever you're going to get by sticking it in the bank. So
So
even
three
if
3% above the cash rate. Just to be clear, the
yes,
cash rate is the rate that the Reserve Bank, the Central Bank of Australia, sets,
yep,
and 3% above that is likely to be higher than what you'd get in a savings account. You can get that in your super
absolutely,
fund, and the government guarantees that for you, rather than letting it move up and down with whatever the fund return actually is.
yes. So even if you weren't going to benefit from any tax deductions, and even if you weren't going to benefit from the co-contribution, this could be a way that you could benefit because the amount of money that it will be calculated to earn for you will likely be high. It will be a guaranteed higher amount than what you could get in the bank, and possibly higher
Mm,
than if you were to invest it in shares or some other asset.
brilliant. And there's a first home savers calculator available online too for people. If you go into Google and search first home savers calculator, first home savers super scheme calculator, you'll find something that should give you some inputs where you can say what's your income and so forth, and you should be able to see how much that saves you, how
Mm,
much money you'll have extra when you decide to buy the home.
mm.
Um, Another strategy that I wanted to ask you about to save money and contribute to super, or save tax and contribute to super, is a spouse contribution.
So this is a good one for
Can you?
low income
Yeah.
earners because there's no
Mm,
requirement for somebody on that low income to be earning any money for themselves from their own exertion. So suppose one partner is staying at home raising kids or staying home studying or has even just retired a little bit earlier. if there's somebody who is earning less than 40 grand a year, then what you as a couple can do is choose to put money into that lower income earning spouse's account as a spouse contribution, and then the higher income earner will receive a tax rebate of, it's 18 cents in the dollar, and it's capped at $540. So the
Yep.
most that you would put in for the purposes of getting the spouse rebate would be $3,000. Now, you can put in more, but you won't get any more than $540 as a tax offset.
Great. So to be clear, let's just say, I don't want to preempt anything, and forgive me for this embarrassing example, but just for our listeners, imagine you and I were married. I'm the husband, you're the wife. Okay, just to put a name to a face. We've now, let's just say, had our first or second kid, and you've taken some time out of the workforce. Okay, so I'm now working. I'm earning 130,000 or something like that a year, 100,000 a year. You have no employment income this year. Okay, so I've now saved up $4,000 in my savings account, and I'm going to give you $1,000 because you have no other income. So that $1,000 you can put in your super fund as an after-tax contribution. It can come from our joint account, and you'll get $500 from the government, assuming you're below the threshold.
So if I've done some work in that year, so if I had maybe worked a little bit before I went on maternity leave or something, then that would be good.
Yes. Yep. Perfect. And then in addition to that, I can put another $3,000 into I can pay it directly from my account into your super fund as a spouse contribution. So the benefit of that being you get a $3,000 contribution as well as the $1,000, and I get a $540 tax offset, assuming you're below the threshold and all the conditions are met.
Correct. Yeah.
So in that 1 year, potentially that's an extra $500 for the co-contribution and an extra $540. So that's $1,040 saving in that example.
Yes. So
in addition, you're getting a little bit more. Sorry, go ahead. No, you go ahead.
Oh, I was just going to say, provided we were okay to not have the use of that $4,000 until we were able to get at it when we got to age 60 and retired, or age 65. So,
yes.
Yeah, that would be the real warning that we'd have to be mindful of.
Of course. But then I think on the flip side of that, it's also really important. A lot of Australians are, understandably concerned about locking money away for super for a long time. The flip side of that is that we really need to think early about our retirement. Like the earlier the better. Like 18 is the right age to start thinking about your retirement, so that we get the benefit of making good decisions and letting that compound and grow for a long period of time. And I often speak to people, they say, well, I'll worry about my future self later. I've got other things to worry about now. That's okay, but it's also sometimes worth considering whether those things you're worrying about now they're unattainable for future you. So you're taking too much now, and you're not going to have that retirement when it comes because you're doing things now that prohibit you from saving additional money in super and doing these other things to balance some of that of your lifestyle spending for future you.
Yeah, absolutely. As with anything, you begin with the end in mind. So for a really short-term example, you might accept an invitation to go to somebody's party. You always kind of want to have an idea in your head of when is it that you'll be able to leave. Maybe that might be after cake's been cut, or maybe you might want to stay a long time, but you want to kind of know, when is it that I'm going to be able to get out and how am I going to do that? It's the same with entering the workforce. When are you going to get out of the workforce, and what do you need to make that happen in the time frame that you would like that to be?
Exactly. That's a great example. Yeah. And before we jump on to the joys of defined benefit schemes, in the context of some of the proposals that the government's now recommending, can we quickly go through, let's say salary sacrifice, and then to finalize that discussion we've just had about those different contributions, we'll divide them up into concessional and non-concessional, or deductible and non-deductible contributions, so that people can get a sense of those two types of contributions.
Yeah, sure.
So salary sacrifice, how does that work?
So salary
and why is it good?
is basically opting to forego some of your salary now and have it be used for other purposes. So I'll assume, but for the purposes of this podcast, that would be superannuation. You can
Yes.
choose, if you want, to direct some of your salary to go not to you at all, but to go straight to your super fund. Now, the advantage of doing that is you're putting extra money into your super, and it's going to be taxed concessionally. It's going to be taxed at 15%, whereas if you elected to have it paid to yourself directly into your bank account, it's going to be paid, you're going to pay tax on it at your marginal rate, which is going to be anywhere from 21% and above, assuming you're earning over
Yep.
18,200 a year. So
Mm-hmm.
you'll save money in tax by doing it that way. You'll also, for some people, you won't miss it. Basically, because you've never seen it, it's gone straight to the super fund. There can never be that temptation to spend it. So some people like to do this with pay rises that they get. They go, well, I'm living just fine on the pay that I've got, and so when I get a pay rise, I'm going to direct that to go automatically to my super because I won't miss it. Now, for most people, you can cancel a salary sacrifice arrangement at any time. So if you find that you're struggling to cope with this, then you can adjust it. Depending on your employer, you may have to pay a fee to make this adjustment. So it may not be worthwhile to do sort of on a fortnightly basis, but once or twice a year would be okay. As an example, state government employees who use Super SA, they have to pay $44 each time they change a salary sacrificing arrangement. So they don't want to do that too often.
Yep. Brilliant. So bringing it all back together, we've really got two main types of contributions to super: before and after tax. Before tax, the concessional, are the ones we can claim a tax deduction for on the money going in. And it's going in before we even pay tax on it, which is why we get the concessional rate. The non-concessional is money that we've already got and paid tax on. So we've sold a property, it's in our bank account, the cash is in our bank. We've been paid our salary and the taxes come out. That money we can also put into super, but we can't claim a tax deduction for it. It's going in just as after-tax money. And the only benefit of doing that is, if there is one, is a concessional rate on the earnings in super, because that's another thing that super does, is it taxes the earnings at a lower rate than what they would be in your own name if you're on a higher rate. So two types, and there are multiple strategies around what you might use them for. So you can salary sacrifice or make personal concessional contributions. You can use non-concessional contributions, and both might give you some benefit from a tax perspective and might actually not cost you very much in your pay. So for example, when you salary sacrifice $50, it's not $50 that actually comes out of your pay because it's before tax money. So it doesn't feel that bad. And sometimes it's worth considering speaking to your employer and saying, can I salary sacrifice $50 a week just to see how it feels? Because often you don't even realize.
Yeah, that's true.
It's called paying yourself first before you go spend the money.
Absolutely.
Great. Now, let's jump into defined benefits really quickly. This is a really difficult topic, so I don't want to go into too much detail. What I want to just do, if you could explain to me or to our listeners, the difference between a defined benefit, which may not apply to a lot of our listeners, but it may apply to some, and a regular public offer super fund. And also, why is that important in the context of the people making the rules right now and all the complexity in the system? I think it's worth reiterating that the public officials in Canberra who are making the rules for all of us that are so complicated have a defined benefit scheme. They don't have the same rules as us, which is, in my view, problematic in of itself. So I'm keen to hear your thoughts.
Yeah, so a defined benefit scheme is one where the amount of money that you're going to have when you retire is worked out according to a set of rules, usually based on what you were earning while you were working for your employer. And it may or may not be linked to how much you personally choose to set aside. So it's, as you say, it's problematic given that the people who make the rules aren't the ones who have to live with the rules because they have their own separate super schemes. That is a conversation for another podcast because we could talk for a while on that. Some of the older schemes are really quite good, and they're older and they're closed because they are so good. There's
Mm,
not many schemes that are left, and it's going to it will depend on what your particular occupation is as to what is available to you. As a
mhm,
general rule of thumb, they don't make things get better for employees. So if you're in
mm,
one and they're offering you the chance to move to something else, usually it's not going to be better. Usually you're better off staying where you are. But that's not a
mm.
golden rule. There are certainly exceptions to that. But
Yep.
that would be something to be mindful of. So if you've had an offer presented to you, you probably should get professional advice from an objective, independent third party to make certain that
Yes.
you know the consequences of going one way or the other. Um,
Mm,
Now, the thing about defined benefit schemes is a lot of the advantages of an accumulation scheme, which is basically where you put the money aside, you can still have that because you can still run your own separate superannuation fund. Like just you can join an industry super fund or something and have your own account balance running alongside, as well as the employer's defined benefit scheme that you're a member of. So you get to be in both if you want to, subject to the caps on how much money can go into super each year. But for
yep.
instance, some of the defined benefit schemes won't let you use the first home super saver scheme. That doesn't mean
Hmm.
you miss out. You just need to open up a second superannuation account, with an industry fund or a retail fund, and put your
Mm.
money in that way, and you can still take advantage of something like the first home super saver scheme.
Excellent. So for some of us, and if we're old enough, we're lucky, we get a defined benefit that's essentially it's defined by law in a
Mm,
formula for our benefit when we retire. The rest of us mere mortals, we have to decide how our money's invested and what risk to take.
mm, that's right.
Um, now, one question about death benefit nominations. So a lot of people don't realize that superannuation is not part of your will automatically.
Mm,
It's not
mm,
part of your estate, right? And it can be a big benefit for people. A lot of people that have insurance in their fund without knowing it.
mm.
So, God forbid someone dies, they're young, and a few $100,000 goes into their fund, and it's just sitting there for the trustee to make a decision about. Can you explain to me what the death benefit nomination is and how they work?
So your death benefit nomination is who you nominate to receive your super funds on your death, and that would, if you
Yep.
have insurance within super, so death cover, then that would be included. So your death benefit amount would be the balance of your super fund plus whatever your life insurance was. So as
Mm-hmm.
Anthony says, that can be quite a lot. Um,
Mm-hmm.
Now, there's rules about who you can leave your super to. So you can't just, for instance, leave it to your mum and dad. It's just not allowed. If you want your super to go to your mum and dad, then you have to nominate it to go to your estate or to your legal personal representative, also known as your executor or executrix if they're female. And then in your will, you say, I want my super to go to mum or I want my super to go to dad, or something like that.
Okay.
So,
So you have to point it to the will first, and then decide
yes,
in the will. If you want it
yes,
to go to somebody who's not allowed to receive it in the super laws.
yes, that's right. And it is important that you make a nomination so that what you want to have happen to the money actually happens. So let's say you were a 23-year-old person and maybe you were living with somebody. It was a romantic relationship. You'd been with them a couple of years, but it wasn't really that super. You didn't know if they were the one for you or not. And you would want any of your super money to go to your parents at this stage. Maybe in 5 years' time, you might feel differently, but that's how you feel at the moment. If you just nominate on your form for your super to go to your
Hmm.
parents, and look,
Hmm.
you can fill out the form properly. You can even have it correctly witnessed by two people. But when you send it off to the super fund, there's a very good chance they won't check it. They'll just put it in your file. Right? And nobody will
Yep.
actually look at it and go, oh, hang on, you've nominated mum and dad. That's not allowed. It will just go into a file and it won't be looked at unless you die. Now,
That's it.
if, God forbid, you are hit by a bus and you do die, the super fund will
Yep.
then look at the form. They'll see that it shouldn't go to mum and dad because they can't, by law, pay it to mum and dad. Your romantic partner, who you were sort of semi-serious about or not, they may stick up their hand and say, hang on, I'm the spouse, give it to me. And the super fund will go, spouse, we're allowed to pay it to a spouse. And that may well be what they decide to do, which
Yes.
mightn't be what you wanted to have happen to your money.
Yes. And if you've made it, and one last point I should make is there's binding and non-binding death benefit nominations. If you make it binding, the trustee will have no choice but to pay it where you nominate, as long as they're a relevant person that's allowed in the law, not to someone that you're not allowed to pay to. But then they typically, in super funds, public super funds, they'll lapse every 3 years. So if there's any uncertainty, every 3 years you need to fill in one of those forms again. If you want it to be binding, get the witnesses to re-witness the thing and make sure it's still accurate if you've got any need to do that. Last question for you today. Really, probably the most important one of all, and I'm conscious we don't have a whole lot of time, but retirement is a huge transition. Okay, for many people, they find it really difficult to stop working. It defines who they are for a big part. So how should your strategies around money management change when you're planning to enter retirement, or even you might not want to actually stop, but you might need to? So you're in the retirement zone, let's call it.
Okay, so the first thing that I would want to say is be mindful that you may live a very long time, and that is certainly the hope for most of us. Your superannuation might have to be looking after you for 30 plus years, maybe even 40, depending on how early you retire and how good your genes are. Really.
Yep.
So you need to resist the temptation to say, I can't afford to have volatility. I really just want to keep my capital preserved and that's it.
Yep.
It's tempting because you do worry about, losing money, but you can't, unless you've got a lot of money, far more than you need. Most people can't just take that sort of approach where they go, I don't want to see my account balance drop ever, so I'm just going to be invested in cash or in really conservative investments. For most people, what you live on in retirement is money that you make after retirement. Because at retirement, that's when your super balance is usually at the highest, and so therefore earning the most for you. And so that is then what you're living on for quite some time.
Yes.
So
Yes.
in terms of managing your money before that, you do need to be mindful of the risk that markets may crash, just as you're getting ready to stop work. That's called sequencing risk. But the way to deal with that isn't to switch from all growth to all defensive. You need to segregate out your money so that some of your money is invested defensively, I like cash, so that
Yep.
you can withstand any market falls. But then the rest of it is still going to need to have that exposure to growth assets so that it can grow and deliver the income for you that you need over the next, few decades.
That's a really good piece of advice. Risk is everywhere. It's not just risk of things going up and down. It's also risk of not meeting your longer term objectives and ensuring your money keeps up with the cost of living. And JC, we're going to have another podcast with another guest about investing too. So we'll cover that in more detail then. Today's been a really great, short but quick, quick but fun, I should say, interview or discussion around some of these interesting topics in superannuation that we all need to pay attention to, whether we find it interesting or not. Unfortunately, we now have that requirement as much as knowing, how much tax we're paying when we sign our tax return. We also have to understand that in future the government might not provide for us the way we expect, and we need to, we're expected to understand this ourselves. The piece of, the recommendation I'd give to any listeners as they're approaching retirement is always get some financial advice. Don't think you can do this on your own. Independent financial advice from someone like JC Taylor at Periapt Advisory is a really, really worthwhile investment. Can't recommend that enough. JC, thanks so much for joining us today. It's been a real pleasure, and I look forward to speaking to you again soon.
Thank you for having me on.
Thank you.
Cheers.
If you like this podcast, please subscribe, like, and share with your friends and family.